Hello everyone and welcome back to the world of finance. Now in this important session of our discussion, we are bringing a very significant matter to discuss, and that is sensitivity of the bond. Now people make investment in fixed income instruments like bond, believing that this is a kind of risk-free investment because the returns what they are going to get are almost stable returns. Nothing wrong about that philosophy, it is indeed correct. But is investment in bond truly risk-free? The answer is no. It is not completely risk-free. Even if it is government bond, it is not completely risk-free. Though we do assume that investment in government bond is kind of risk-free investment. However, there is something that brings volatility in the bond price, and that is changes in the interest rate. So let us understand one simple fundamental, that is the price of the bond today is a reflection of the present value of all the future payments that it is going to offer, all the interest and coupon payments along with the par value that will be redeemed on maturity, that is the principal amount paid back to the investor on maturity. All these future cash flows, when you bring them down to their present value, that lump sum present value indicates the current price of the bond. And for this purpose, you are using the discounting rate, which is generally referred to as the yield of the bond, or YTM, that is yield to maturity of the bond. Now, from where do you get this YTM is a question, and it is the YTM that defines the current market price of the bond. So by calculation, someone would say that YTM is the yield of the bond which is dependent on the current price of the bond and the future cash flows that the bond is going to offer till its maturity, and the yield to maturity is derived out of that. Nothing wrong about that again. But if you think the other way, it is the current market price of the bond which is derived from the information about the future cash flows of the bond discounted using the YTM prevailing at present. So what is the YTM prevailing at present depends on what is the interest rate prevailing in the market. That becomes your expectation, and with that you start discounting the future cash flows to their present value. In other words, interest rate in the markets are not going to remain stable all the time. In fact, interest rate changes frequently. Just like any other market, the money market and bond market, they face this kind of volatility of changes in interest rate. As a result, with the changes in interest rate in the market, the YTM, that is the yield to maturity, which is the rate of return of the bond, or you can say the internal rate of return of the bond, that changes. As a result, the current price of the bond also changes. How much a bond is sensitive to the interest rate movement is measured through sensitivity of the bond. For example, if there are two bonds A and B, and if I say interest rate in the market has declined by 20 basis points, do you think both bond A and bond B will have exact same impact? The answer is no. They may have different effects, and that effect depends on which bond is more sensitive and which bond is less sensitive to the interest rate movement, and that is where we are bringing the sensitivity of the bond in the context of this calculation. Now, generally most of the CFA students who watch my classes on bond duration and volatility, modified duration, all these aspects, they ask me, sir, why are we beginning our discussion with the sensitivity? Because in our curriculum, sensitivity of the bond is not there. But sensitivity, what I am referring as sensitivity over here, in your curriculum it is referred to with a little different title, and I'll just bring forward that as well. So I want you all to pay complete attention and watch this entire video so that you get complete clarity and connection among various aspects. Number 1, the sensitivity of the bond. Number 2, Macaulay's duration. Number 3, modified duration. So computation of modified duration, application of modified duration, and even making estimation of the approximate modified duration. This whole thing will be followed by 2 more important terms that will be explained and discussed in this class, and those 2 important terms are money duration and price value of a basis point, and why money duration supersedes the concept of PVBP. Fundamentally, we will try to understand with calculation evidences. So stay connected throughout and look into what we derive out of this whole discussion. So coming back to our point, bond sensitivity or sensitivity of the bond is a measure of how much a bond is sensitive to interest rate movements. Now one thing is very clear, because these interest rates are going to define the yield of the bond, and yield will be used as a discounting rate. Now we know one thing mathematically, if discounting rate is higher, the present value will be lower. That means the interrelationship of interest rate and the bond price, these are inversely correlated. Means if the interest rate rises, the price of the bond will drop. If the interest rate drops, the price of the bond will rise. So graphically when presented, it will give you a downward sloping trend. So let us write some important notes about bond sensitivity over here. Interest rate sensitivity is a measure of how much the price of a bond will fluctuate due to changes in interest rate. Securities that are more sensitive have greater price fluctuations than those with less sensitivity. This type of sensitivity must be taken into account when selecting a bond. Fixed income securities and interest rates are inversely correlated. Therefore, as interest rate rises, price of the bond tend to fall and vice versa. So please write up this much and then I take you ahead. Alright friends, once we have completed writing this much, let us move ahead, and now we talk about how do you measure the bond sensitivity. Sensitivity is measured by taking summation of N into PV divided by 1 plus YTM. Now this summation of N into PV, N represents the respective number of years for the required cash flow in the bond. It could be 1, 2, 3, 4, 5, so on up to the life of the bond or up to the maturity date. And PV is the respective present value of each year's cash flow. So present value of each year's cash flow will be multiplied to the respective number of year, and that summation will be divided by 1 plus YTM to arrive at the bond sensitivity. See, it is not the calculation that matters. What really matters over here is how do you apply this sensitivity for bond analysis. Now one very important thing over here, the above computed bond sensitivity indicates its money duration per $100 of par value. Now the currency mentioned over here is dollar, because mostly this concept is mainly referred to by CFA and FRM students. Now the point is, it can be any currency, it could be Indian rupee if you are talking in Indian context, but the concept still remains the same. So the par value of the bond is generally considered as $100. In that case, if the par value of the bond is $100, then this sensitivity what you have computed is nothing but the money duration for every $100 par value. This money duration is in your curriculum, and what happens, not able to understand that this money duration for every $100 par value itself is nothing but the sensitivity of the bond, that failure is not going to help you at all. You should understand that just in other terms it is known as bond sensitivity. Now where it is going to be used, with a little change of the interest rate in the market, how bond price will fluctuate, that indication can be obtained from this bond sensitivity, and that is what we are going to learn in this class. So the measure can be directly applied to observe the impact of changes in interest rate. So write up this as well, and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead, and now we talk about the duration of the bond. When it comes to understanding the duration of the bond, one thing many students and many professionals, they generally refer to the life of the bond as duration of the bond. Say duration of the bond is 5 years. It will be incorrect in the bond market to use duration as life. Duration has its own meaning. So when generally we say duration of the bond, it is always measured in number of years, and this duration calculation is precisely referred to as Macaulay's duration. Let me mention Macaulay's duration. What exactly is Macaulay's duration? See, a bond is going to give you the returns. So today you invest money in bond, and you are going to get back that money over certain number of years in future. So you will have to wait until the bond is finally matured when you get back all your money. But that maturity is the date on which you get the last cash flow from the bond, but that is not the only cash flow unless it is a zero coupon bond, because in zero coupon bond the principal amount repaid on maturity is the only amount that you are going to get. So for a zero coupon bond, its life and duration are going to be the same. Point is, a coupon paying bond may not have its duration matching with its life. Its duration will be shorter than its life because it is the weighted average of all the number of years which is addressed as Macaulay's duration. In other words, Macaulay's duration is nothing but the weighted average of all the number of years. For example, if a bond life is 5 years, then you are going to get some cash flow in year 1, 2, 3, 4 and 5. The weighted average of these 5 numbers is what we call as Macaulay's duration. And what are weights over here? Weights are the proportion of present value of cash flow obtained in each year compared to the total present value of the bond or the bond price. So the computation of Macaulay's duration is also very logical, and when you have to compute, it is summation of n into PV divided by bond price. In illustrations ahead, I am going to even show you how to exactly derive this formula logically, correct? But I would right now want you to note it down quickly so that we can move ahead. Alright friends, once this is completed, let us move ahead, and now we talk about modified duration of the bond. Now this brings much more excitement to this discussion. Modified duration. So in real life, the application of Macaulay's duration definitely is there. It is an important calculation and an important feature that is applied in reality as well. Particularly when you are dealing with the concept of bond immunization, the duration of your bond portfolio has to match with the investment horizon that you have targeted. That is where Macaulay's duration has a wide range applicability. But in almost all other cases, it is the modified duration which works more effectively. Modified duration, in many textbooks, it is also referred to as volatility of the bond, but I would refer for CFA and FRM students just to mention this as modified duration only. CA students in India can refer this as volatility of the bond as well. Absolutely fine. Now what is this modified duration? So you have learned how to compute Macaulay's duration. Now you take Macaulay's duration and you divide it by 1 plus YTM and you arrive at modified duration. In other words, if suppose the YTM rate is 10%, then whatever was Macaulay's duration divided by 1 plus 10%, that is divided by 1.10, and you get the modified duration. Now computation of modified duration can be done by actual practice, what we have just talked about, or it could be computed by an approximation approach as well, which also we are going to discuss in a short while in this class, how to apply approximate modified duration. But before we move on to that part, what is the application of modified duration? That is very, very important. Let us assume that there is an annual coupon paying bond. That means the bond is giving you coupon payment once every year. And when you computed the modified duration of that bond, suppose it comes to exactly 4. That 4 has a specific meaning. Now say, if the interest rate rises in the market by 1%, means if the YTM of the bond rises by 1%, the price of the bond will fall by 4 times of 1%, means it will fall by 4%. So if interest rate rises by 1%, bond price falls by 4%. If interest rate rises by 0.5%, the bond price will fall by 4 times of 0.5%, that is by 2%. This is how you understand the modified duration application. It is the meaning and application of modified duration which is very, very essential, and it is the modified duration that becomes the base for dealing with money duration, which we are going to discuss later in this class. But let us first write some important notes about what we have just discussed in the context of modified duration. It measures the percentage change in a bond's price for 1% or 100 basis points change in the yield or YTM. It gives you how sensitive the bond's price is to small changes in interest rates. And how do you compute modified duration? It is for annual pay bonds, Macaulay's duration divided by 1 plus YTM. Now keep in mind one thing, if you are writing this as a formula, it is basically for annual pay bonds. If it is a semi-annual pay bond or a quarterly pay bond, then there will be slight adjustment to be made in this calculation, and that I am going to explain later in some other class. But I want you to write down this whole thing quickly before we start moving on to examples. Alright friends, once you have completed writing this whole thing, let us move ahead and take up the very first example in this category. What does it say? Par value of the bond is given as $100, YTM of the bond is 12% per annum, coupon rate which is payable at end of each year, which signifies that it is an annual coupon bond, it's 10% per annum. So you know one thing, coupon rate is always applied on the par value. So your payment of interest will be $10 every year, and the maturity will be after 5 years. That is the life of the bond, or you can say the remaining life of the bond or tenor of the bond. Now they have asked you to determine the following: bond price, bond sensitivity, modified duration, which will be the follow-up of Macaulay's duration. So first Macaulay's duration, then modified duration, then revised bond price if yield decreases by 50 basis points, and revised bond price if the yield increases by 50 basis points, and at the end it is asking you to compute approximate modified duration. Now in the earlier discussion what we had, I have not explained to you theoretically how to arrive at approximate modified duration. It is just a calculation approach which will give you the value very close to the modified duration, but you need to understand and learn both of these from your examination viewpoint anyway. So let us see how to present the solution of this. We start with a simple calculation in this table. We take years as 1, 2, 3, 4 and 5 marked as N. The cash flow each year will be $10 towards the interest payment or coupon payment, and at the 5th year end you will be getting $110, that is $100 towards the par value and $10 towards the interest or coupon payment of the last year. Now because the YTM is 12%, all these cash flows will be discounted to their present values at 12% discounting rate, and I don't have to explain to you now at this stage how to compute the present values. You have learnt it in all the videos earlier. So now you just convert all these cash flows to their respective present values using 12% discounting rate. So for the first year the PV is 8.929, then second year, third year, fourth year and fifth year. Now aggregate of all these present values will give you the bond price today. Because the discounting rate was YTM, the aggregate present value will be the bond price in the market today. And for computing the bond duration and sensitivity, you need to multiply N with PV. Now this is the PV column, this is the N column, N into PV is what you have to do. So when you do that calculation, N into PV, the aggregate of N into PV becomes the base for computing sensitivity and bond duration. So the aggregate of PV will be declared as the bond price today, that is $92.79, and the sensitivity of the bond will be computed by taking summation of N into PV divided by 1 plus I. I over here is the rate of return, which will be nothing but the discounting rate which was applied as 12%. So in the numerator we should take 383.731, that was the aggregate of N into PV, that is summation of N into PV. So 383.731 divided by 1.12, and this gives you 342.617. Now what is the real interpretation of this sensitivity? I am going to explain to you later. So please note down this part of the calculation and then we move ahead. Alright friends, once these calculations are completed, let us move ahead and do the next calculation, that is of Macaulay's duration. Summation of N into PV divided by bond price. Summation of N into PV we already got as 383.731 from the earlier table, and 92.79 is the bond price. So when you compute this, you get this duration in number of years. Real life utility of this is very restrictive. This mainly is applied in the concept of bond immunization. And now our major focus is on the next calculation, that is modified duration, that is Macaulay's duration divided by 1 plus YTM, and that gives you the result as 3.6924. So when you get this modified duration, right from this point, what should be your perception? Your perception should be very clear that if modified duration is 3.6924, that means if the interest rate in the market rises by 1%, the bond value will fall by 3.6924%. So it is 3.6924 times of the interest rate movement, and that too in the opposite direction. So it is the magnitude and the direction of the price. So magnitude is this many times the price will change as compared to the interest rate. So if there is 1 basis point change, 1 basis point is what? 0.01%. So 0.01% multiplied by 3.6924 times, that much will be the change in the bond price in the opposite direction. When I say opposite direction, means if the interest rates are rising, obviously the bond price will fall and vice versa. So before we move any further, please write up this point quickly. Alright friends, once you have completed writing this whole thing, let us move ahead and take up the next part, that is revised bond price if yield decreases to 11.5%, because they have asked you what will happen when the YTM reduces by 50 basis points. So 50 basis points, when you are reducing from the given YTM of 12%, I am sure you understand this point very well, that one absolute percentage is equivalent to 100 basis point. So if there is 50 basis point decline in the interest rate, it means that the interest rate has declined by 0.5%. From its initial level where YTM was 12%, it has come down to 11.5%. So what you need to do, you just need to pick your financial calculator and input all the values. See, earlier we had to make the calculation by the table. Why? We had to make the calculation by table because we wanted the calculation of N into PV. Now you could have done it directly on your calculator as well by manually multiplying each N with respective PV and continually storing the values as STO1, STO2, STO3 and so on, and finally you recall all the calculations and take the aggregate. But that kind of calculation is asked in examination very rarely. What is asked in examination is the approximate modified duration, which we have yet to identify how to do it, and most importantly the application of modified duration, which we are going to understand, and connecting that with the other related concepts like the money duration and the price value of a basis point. But before I take you ahead, let us just first focus on this possibility: the revised bond price if the yield decreases to 11.5%. So pick your financial calculator. So N should be input as 5, I by Y 11.5, because earlier it was 12, now it became 11.5. PMT is 10, FV is 100, and CPT PV will give you the revised price of the bond, which comes to now 94.5252. The result will appear on your calculator with a negative sign. You know the reason why it happens, but you are just going to conclude it this way, that the revised bond price is going to be $94.5252. Similarly, you make one more calculation: revised bond price if yield increases to 12.5%, because we are making both side changes in the YTM. That is, first when YTM reduces by 50 basis points, and then when YTM increases by 50 basis points from the base YTM of 12%. So what you can do in your financial calculator, you will actually have to make only one change. Do you know what one change? I by Y, which was earlier feeded as 11.5, now you make a fresh feeding of I by Y as 12.5, N, PMT and FV remaining same, recompute PV, that is CPT PV, and you will be getting this as the revised bond price. So the revised bond price comes to $91.0986. Please take note of these calculations and then I take you ahead. Alright friends, once completed with this much, let us move ahead and continue further. Now we need to understand how to compute approximate mod dur, that is approximate modified duration. Now please do not get carried away with this formula, because in different textbooks the style in which the formula is written is little different. So logically try to understand what is to be done over here instead of sticking to the formula. So what I have always been following, it is P plus and P minus, and the difference between P plus and P minus. Now P plus is the increased price of the bond when the yield has declined, and P minus is the reduced price of the bond when the yield rises. So the increased price mentioned as P plus and reduced price mentioned as P minus. That means from the higher price you have to subtract the lower price. Now what are these higher and lower price, and what is this P0? P0 is basically the indication of the original price of the bond which we computed with the given YTM already. So we have been given in the example the YTM as 12%. The price that we computed for 12% will be P0. And let me take you a little backward to the previous working. Do you notice when the yield decreases, the bond price rises to 94.5252. This is P plus, and when the yield increases, the bond price declines to this is P minus. Now in some textbooks you will be finding the presentation of formula given little different. I don't follow those variables over here. In some books you will be finding P minus minus P plus, and they have defined P minus and P plus inversely. So it is just about how you define the variables that you are using in the formula. Your logic should be very clear, and I am going to explain these variables and the required logic over there. P0 is the original bond price, which was $92.79. P plus is the bond price when yield falls. So when the yield falls, the bond is going to have increase in the price. That is why we refer this as P plus. For me, the indication of P plus gives a better understanding that price has increased, correct? And P minus indicates the bond price when yield rate rises, because the bond price will actually fall. So as I told you, don't go with these variables and the formula. Logically you should take the difference between the higher price minus lower price in the numerator. So in my variables applied over here, it is the high price mentioned as P plus and the low price mentioned as P minus, and that will be divided by twice the original price, and that will be multiplied to delta y. Delta y is the, delta indicates the change and y indicates the YTM. So change in the YTM, one side change in the YTM is 0.5%. So delta y is basically 0.5%, and we are going to define that as well. And keep in mind one thing, don't substitute the value over here as 0.5, because 0.5 is basically 0.5%. In the absolute form it will be 0.005, and then when you apply all these substitutions in this formula, what you will get is 94.5252 minus 91.0986 divided by 2 times of 92.79 into 0.005, and that gives you 3.6929 by calculation. If you can recall, the computed original modified duration where approximation wasn't applied, it was 3.6924, and this is 3.6929. This is very close to what you have computed otherwise. So please take note of these calculations, and then I take you ahead. Alright friends, if you are clear with all these calculations, let us move on to the next example, which is in continuation of the earlier example. Just to make sure that we don't cluster everything into one big example, I have split this whole scenario into multiple parts, and example 2 and the follow-up of the same, that is in example 3, and the conclusion that we are drawing, I am going to split this whole discussion into multiple parts so that your understanding is crystal clear and you don't try to make everything clustered into just one thing. So let us focus on example 2. It says, consider the data from example 1 and answer the following. What is the purpose of modified duration? If the yield decreases by 50 basis points, what is the estimated revised bond price using only modified duration and ignoring convexity? If the yield increases by 50 basis points, what is the estimated revised bond price using only modified duration, ignoring convexity? Now the moment you read this example, the first thing that comes in your mind is, sir, what is this convexity? So those who have never heard about convexity, don't bother about it. By later stage, I am going to give you a little bit of explanation on what is convexity, why convexity adjustments might be needed, and then anyway the later part of this whole series of discussions will bring convexity adjustment also into picture. But I'll definitely set a platform which will give you clarity about what is the need for bringing convexity adjustment into your calculations, and how to do that will be the later part of our discussion, which we are going to learn in convexity chapter. So let us first deal with this particular example, and let me straight away take you to the solution over here. Purpose of modified duration, I think we are very clear in this regard. We have learnt it very well. Modified duration measures the percentage change in the bond price for 1% or 100 basis point change in the yield to maturity or YTM, assuming no change in the cash flows and ignoring convexity. So again, this term convexity, if it is coming to you as a botheration, I would say, if this modified duration application is ignoring convexity, temporarily please you also ignore this convexity. I'll discuss it definitely at a little later stage. So that was the purpose of modified duration. Now let us go for the application. Revised bond price using only modified duration. So change in bond price. So what happens? Modified duration into change in the yield multiplied by bond price at YTM. This is the manner in which you arrive at the change in the bond price. So mathematically, change in the yield was 50 basis point, that was 0.5%, or on absolute basis it was 0.005, and modified duration number of times the bond price will change as compared to the yield. So yield change was 0.005. So the bond price will change by 3.6924 times 0.005, and that multiplied to the current price of the bond price will change by $1.713. Now this change is going to happen in the opposite direction. Why in opposite direction? Because bond price is inversely related to the change in the interest rate. So please write up this as well, and then I take you ahead. Alright friends, once you have completed writing this whole thing, I want you to focus on this whole thing. So let me explain something very crucial. Graphically, when you are showing the bond price and interest rate interrelationship, x-axis is where you indicate the interest rates or the YTM or the yield. X-axis indicates the yield, that is horizontal axis. The vertical axis, that is y-axis, that indicates the bond price. So what happens? Mathematically, if I have to write up the equation of a straight line, it is y equals to a plus b into x. A is the intercept, b is the slope or the coefficient of the variable x. It is basically the slope of that line, and x is the independent variable. So changes in x, which is the independent variable, will bring about the changes in y, which is the dependent variable. Now if you focus on one thing, when we make this calculation, what is the dependent variable? It is the bond price, because bond price is depending upon the changes in the YTM. So changes in YTM is the independent variable. That means this thing, that 0.005, that is delta y, is basically the x value in the equation of the straight line. So don't get confused between x and y over here, because x in the equation is the independent variable, and factually it is the YTM which is that independent variable. So it is YTM which is graphically expressed on x-axis. This is that, and the product of the bond price and the modified duration, which actually represents money duration, is the slope of that line. So when we say y equals to a plus b into x, this whole thing which you got as 1.713 indicates that b into x term. So we have computed this b into x term. Now when I take you ahead, what happens? If the yield decreases by 50 basis points, the bond price will rise. How much the bond price will rise? So this revised bond price is the y value in that equation of straight line. So y equals to a plus b into x. A is the intercept, that was the previous price of the bond, that was 92.79, and because the bond price is going to rise, you are going to add something to this, and what you are going to add is 1.713. So as I told you, in the equation of the straight line, y equals to a plus b into x. This is a, and this is the product of b into x, which we have already computed earlier. So a plus b into x will give you the value, but this is the value that is plotted through that straight line equation. Look at one thing, this is not the actual price of the bond when the yield decreases by 50 basis points. The actual price of the bond you have computed in the earlier example. Can you recollect what was that earlier example? The earlier example, example 1, you have already computed. If you can just turn back the pages and see what you wrote, you would have written the actual price of the bond in example 1 when the yield decreases by 50 basis points is 94.5252. If you compare these values, they are different. Why they are different? Let me explain this to you. Now see what happens. Graphically, just visualize. Okay, I'm not showing that graph on the screen right now, but if you can visualize, first thing, the bond price and interest rates, they are inversely related. Means if one rises, the other will drop. That means if you are presenting this graphically, it will be a trend moving downward, correct? But will it be a straight line? The answer is no, it will not be a straight line. Fundamental question, why it cannot be a straight line? Imagine if it is a straight line, at one point of time that straight line moving downward, 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 it will touch x-axis. When it touches x-axis means the y value is 0, means the value of the bond will become 0. No matter how high is the yield of the bond, its value will never become 0. Can we agree on that? That means it's a clear evidence that bond value will never touch 0. Therefore, it is proven that bond relationship, that is bond price relationship with the interest rate, which is a trend moving downward, sloping downward, but it cannot be a straight line, it has to be a curve which will be convex to the origin, correct? A curve which will be convex to the origin. So if you can visualize a curve and a straight line, they may not have junctions at multiple points. One point of intersection what they had was with the original YTM of 12%. In the follow-up class where I am going to introduce the convexity concept, I am going to bring this graphically in front of you, but right now what is focus point, it's understanding the role of modified duration ignoring convexity. When the convexity has to be brought in, we will definitely discuss. You may be asking, sir, then why are you discussing it right now? I am discussing it only for you to understand that right now there is a factor which we are not taking into our consideration, and that is why there is a gap of these two, and that factor which we are not considering is convexity. So when we consider convexity, this gap will be bridged. But as I told you, we are going to learn this in the next follow-up topic. I'll be making separate video for that, that is the convexity and convexity adjustment. Now just the next part is very simple. If the yield increases by 50 basis points, the bond price will fall. Fall by how much? 1.713. So instead of adding this to this, you subtract it. So your calculation goes this way: 92.79 minus 1.713, which gives you 91.077. But again, actual price of the bond which you have computed in this scenario was 91.0986. These are the calculations already there in your notebooks as drawn from example 1, and that gap is again not matching because of one point, which is this, it is lying on that straight line, whereas this value is lying on that curve. Because both are two different shapes, definitely they are not aligning with each other, and that is where we are currently ignoring the convexity adjustment. So what I can say further, the estimation is reasonably accurate. It's not perfectly matching, but it is reasonably accurate. But the smaller the change in the yield, the closer these values will be. However, for large movements, convexity adjustment becomes essential. So please write up this entire calculation and conclusion, and then I take you ahead. Alright friends, if you have completed this much, let us move ahead and continue further. Now we talk about money duration. Now this is very simple concept. What is money duration? The money duration of the bond, or money duration of a bond position, also called dollar duration. Again, dollar duration because dollar is the currency. It's basically currency based calculation. It is expressed in currency units. So you can call it euro duration or rupee duration, depends on what currency you are using, but fundamentally it is called money duration. How it is computed? It is the annual modified duration multiplied by full price of the bond position. Now when we take numerical examples, you will get better understanding about this whole thing. Now multiplying the money duration of a bond by a given change in YTM as a decimal, that is in the absolute form, will provide an estimate for the change in the bond value for that change in YTM. So what was the role of modified duration? The same role can be brought into money duration. In fact, in money duration you are going one step ahead and showing what will be the monetary change in the value because of the change in the YTM. So you are already accommodating modified duration along with the total value of the bond. And keep in mind one thing, here overall value of the bond comes into picture. So if you are dealing with a single bond, correct, of par value $100, then the money duration will be computed for every $100 par value. But if you are taking the entire par value, for example, in this example, if I tell you that in total there were say 20,000 bonds, each bond with $100 par value multiplied by 20,000 bonds, 20,000 into 100 will give you what? $2 million. So $2 million becomes the total par value. So if $2 million is the total par value of the bond, on that entire value of the bond, what will be the change in that value because of the change of YTM? If you want to bring that, it is again modified duration that makes your task easier. So please write up this and then I take you ahead. Alright friends, let's move ahead, and now we discuss the next very important concept, that is price value of a basis point, PVBP. Now when we are discussing price value of a basis point as against what you can extract from money duration, first thing that you should keep in your mind, money duration and modified duration are more refined measures compared to price value of a basis point. This concept PVBP you should learn only and only to address in your examination. In real life, I will never recommend anyone to use this concept. Therefore, actually speaking, by choice, if you ask me that sir use this concept, I am not going to ever apply that, because it will always have a big problem of rounding off. It is basically computed using averages, and that is where on an average what is the change that is going to happen will give you more approximation, and even convexity cannot bridge that gap. Therefore, real life application of PVBP simply does not exist. So when the calculation itself has a potential error, I mean potential rounding error, calculation cannot be considered as reliable. As a result, you are learning this only and only from examination viewpoint. What is the meaning of this? Let us understand that. It is actually meaningful provided it is not computed through that average, but it is instead computed through the money duration or modified duration. So if PVBP calculation is derived through the money duration or modified duration, it will work fantastic. But if PVBP is arrived through the formulas given in your curriculum, then it will be an approximation formula which is going to give wrong implications. Now, what is the significance of this price value of a basis point? See, if there is a change in YTM by 1 basis point, when I say 1 basis point, it is 0.01%, correct? 1 basis point is 0.01%, but it is still 0.01%. Don't write 0.01 as delta Y. Delta Y will be 0.01 as percentage. So if you understand what is the meaning of percent, it is per 100. So 0.01 further divide by 100 will become 0.0001. So 0.0001 is the delta YTM. So what happens when the YTM changes by 1 basis point? What will be the change in the entire value of the bond? So you are trying to assess what is the price value of 1 basis point. So if 1 basis point movement here and there, the price will go in the opposite direction by how much for the entire value of the bond? That is precisely the price value of the bond. For understanding this concept, what I am going to do, I will introduce an example which will be the follow up of the earlier examples that we have just seen, and in that example I will make you calculate the PVBP through money duration, which is logical calculation, and through the formula based calculation, which will give too much of approximation, and we will look into which calculation base is much better, and we can prove it by actual calculations that which one is more reliable, and we will conclude the whole scenario accordingly. But all these concepts, Macaulay's duration, modified duration, money duration or bond sensitivity, and PVBP, all these, if you learn in isolation, it is not going to make complete sense. You should be able to connect the dots. That is most important. So let us focus on what is PVBP. The PVBP is the money change in the full price of a bond, that is full price of a bond value, when its YTM changes by 1 basis point or 0.01%. We can calculate PVBP directly for a bond by calculating the average of the decrease in the full value of the bond when its YTM increases by 1 basis point and the increase in the full value of the bond when its YTM decreases by 1 basis point. So as I told you, you are going to use this calculation base as an average of these two. Because it is an average based calculation, it lacks accuracy. Anyway, please write up the meaning of price value of a basis point, and then I take you ahead with examples. Alright friends, once you have completed writing this much, let us take up the next follow-up example. Now it is asking in example 3, consider the data from example 1. Fine, we will consider that. Calculate the money duration for the bond assuming a total $2 million par value and for every $100 par value. What will be the impact on the bond value of a 1 basis point change in its YTM? And then lastly, it is asking calculate the PVBP for this bond. So when they are asking PVBP for this bond directly, we will be using that average approach. But when they are asking this, we will be using the money duration or modified duration to answer this part. So based on what we have learnt, let us first look into the calculation of money duration. The money duration for the bond is module times, that is mod duration times the full value of the bond. So the full value of the bond will be $2 million, but it is based on $100 par value. We are taking 92.79% of this. The objective behind taking 92.79% is very simple. For every $100 par value, the price of the bond was $92.79. Therefore, the total market value of the bond will be 92.79% of $2 million. So that becomes the total market value of the bond, that multiplied to modified duration. So modified duration times the total market value of the bond becomes the money duration. So it comes to $6,852,356. And the question has also asked you the money duration per $100 par value. So basically, if you can see, the total nominal value is $2 million and one bond par value is $100. So you can relate and find out that for this whole connection there will be 20,000 bonds, right? $2 million divided by $100 will give you 20,000 bonds. So this is the money duration of 20,000 bond. What will be the money duration of a single bond? So simply you take this calculation divided by 20,000, or you can simply take 92.79% of $100 itself. So instead of $2 million, you take the base as $100. So 92.79% of $100 is 92.79 multiplied to 3.6924. That 342.618 gives you the money duration per $100 par value. And you can compute this by simply dividing the total money duration by the number of bonds. You will still get the same thing. Now, what is most important over here, at the beginning of the first example where we started this whole calculation from, the first thing asked was the bond price and the sensitivity of the bond. Check your notebook. When you have computed the bond sensitivity, you would have got exactly this value. Of course, a few fractional difference may happen because of the rounding of differences, but you can check right away that it would be $342.618 approximately, which you would have computed as sensitivity of the bond. The question is, what will you do with this calculation? That is important. So let me show you the impact of this. So impact of a 1 basis point change in the YTM. So change in the value of the bond will be money duration into change in YTM. So money duration is this whole thing, correct, and that multiplied by change in YTM. Now keep in mind one thing, YTM is changing by 1 basis point, which is basically 0.01%. Further you convert that into absolute value, so 0.01 by 100 becomes 0.0001. When this multiplied to the total money duration, what you get is a change in the YTM of the bond as $685.24. So that means if the yield changes by 1 basis point, the entire bond value will change by $685. So logically this $685 actually becomes the price value of 1 basis point. That is what we call as PVBP. But when you calculate PVBP through that average approach, you will not get the calculation matching with this. This is the real thing which is computed through money duration, but when you calculate through the average, you will be getting approximate value, which may misguide someone, and that is why we do not use it in reality. In reality, we always use this. So please make sure that you have understood this whole calculation, and we will say the bond value will change by $685.24 in the opposite direction. Please write up this whole thing and then I take you ahead. Alright friends, once you have completed this much, let us move ahead and continue. Now YTM of the bond, if you have to compute the YTM of the bond, it will be N equal to 5, PV equal to 92.79 with a negative sign, PMT 10, FV 100. All these calculations we have seen right from the beginning, and when you compute I by Y, CPT I by Y, you will be getting 12. Simply you can check on your financial calculator. In fact, when we started attempting this question, what we did, we took N as 5, PMT as 10, FV as 100, I by Y as 12, and we got PV as negative 92.79. That is how we got the bond price, right, originally. Now what you do is, the values with the YTM of 11.99% and 12.01% if you have to compute. So you now make the changes, that you make I by Y as 11.99 and compute PV, because the yield has reduced. This is going to be the increased price of the bond. We can call it as P plus or V plus, whatever variable you use. If you are increasing the yield rate to 12.01%. So can you notice, from the original YTM of 12%, we are making 1 basis point lower and 1 basis point higher. So logically, between the two obtained values, the gap is not of 1 basis point, but the gap is 2 basis point. So logically, if I take that difference, this difference, and divide it by 2, I will be getting PVBP per $100 par value, right? That PVBP is the difference between these two values, and you are dividing it by 2. Why you are dividing it by 2? If you observe, when you are taking this gap, do you know what it is? It is gap of 12.01% and 11.99%. So this difference in the yield is by 0.02%, means it is the value of 2 basis points. So what will be the value of 1 basis point? So that difference you divide it by 2 to arrive at this. And when you take the $2 million par value and multiply that to 0.0445, what you are going to get is $890. By the average calculation, it comes to $890, but factual calculation through the modified duration or money duration was $685. So I am claiming $685 to be a precise calculation, whereas this is more of an approximate calculation. But in exam, if they are asking you to compute the PVBP, you should use this approach. But keep in mind, you should use this approach only and only when question is specifically demanding the calculation of PVBP. So suppose in exam there is a question which is asking you, what will be the change in the bond price for 1 basis point change in the yield? So anyone can compute PVBP and mention that this will be the change in the bond price. But in reality, your calculation through modified or money duration will be more accurate as compared to this particular calculation. So this calculation should be applied in examination only and only when specifically this is asked in question. Otherwise you should avoid this, because both of these will be having definitely some difference. This is more of an approximation what you are finding on screen. Anyway, quickly take note of this whole thing and then I take you ahead. Alright friends, once you have completed this much, let us move ahead. And now time for us to compute the value of bond at 12% YTM. So I am taking N as 5, I by Y as 12, PMT as $200,000. Why $200,000? Because coupon rate is 10%, total nominal value or total par value of the entire bond position, it is $2 million, right? $2 million into 10% will give you $200,000. So this becomes PMT, that is annual coupon payment will be 200,000 and FV will be $2 million. So instead of taking $100 par value, I am taking $2 million par value and now making the calculation of present value of the bond. The computed present value of the bond comes to $1,855,809. Now what happens if I recompute the YTM at 11.99%, correct? Now what will happen if I compute the revised bond price through a changed YTM? That YTM changes to 11.99%, other things remaining same. So N remains 5, so I don't make that change. I by Y changes from 12 to 11.99, so I definitely make that change. I by Y will be taken as 11.99. PMT and FV remain as it is. So then directly on your calculator do CPT PV, and when you do this, what you get over here is the revised bond value, which is $1,856,494. Now please compare the difference between these two. You will find that this is the increased value and the value got increased by exactly $685. That is why I was telling you that $685 calculation is more reliable. So on complete accuracy, if you truly ask me that what is the correct PVBP without using averages, the correct PVBP without using averages is $685, not $890. Both of these are therefore always going to create confusions in the mind of a student. So student should be very clear that this is more of a reliable calculation because it is proven through these calculations. So you may take note of all these and then I take you ahead. Alright friends, once you have completed this whole thing, let us move ahead and summarize the whole scenario. Why are the outcomes different? Both PVBP and money duration tell you how much a bond's price will change for 1 basis point change in YTM. Money duration is more stable and gives accurate results, hence preferred. PVBP is calculated as an average and is vulnerable to rounding errors. You should use money duration unless explicitly asked for PVBP. So please write up these concluding points, and with that we put an end to this session.